Hey fam, what if your life insurance policy could help you pay your mortgage years ahead of schedule? You down to learn? Let's check it out. So what we have here is a nice home, nice chimney. It's a cold winter's day. You got a nice chimney with the fire going. You got your wife, you got your two kids, you got your nice two windows, you got your nice little door, you got your nice little 2,500 square foot home. You got a nice little home. But like most people, you got a 30-year term, right, on this mortgage. And the interest rate that you know you're going to be paying is more than you'd rather have paid over that 30 years for the term. And so you've been thinking, and you're watching this video right now, if I could pay off my mortgage a lot quicker and sooner, I'll be interested in hearing how to do it. You're at the right place. So let's go. So it's pretty simple, but there are many different ways to be able to, if you have a 30-year term on your mortgage, to be able to pay it off a lot quicker. Some people make one extra payment per month on their mortgage. Some people do that, or some people, instead of just paying, let's say for this home, you're paying about $2,000 for the home. Instead of just paying $2,000 one time per month, what you can do is you can make two payments of $1,000, and that will, just by the amount of payments that you're making, drastically draw down some of the interest as well. So there's multiple ways you could do that, or you can take out a HELOC, you can do a reverse mortgage. It's multiple different ways that you can do this, okay? But for this purview of this video, we're going to use the avenue of life insurance to be able to do it. Now, pretty simple. Cash value producing life insurance, whether whole life or universal life, depending upon what type of client that you are, whether you're more risk adverse or you just want something that's fixed, whole life might be yours, or universal or index universal life policy might be yours. Either way, both of them can work for this specific idea, okay? So the premiums that you're investing over time with the policy, it grows cash value in the policy for yourself, but most importantly, it grows cash value tax free, most cases, okay? And so the policy, the premiums that you're investing per month inside the policy will grow for you. And so depending on what goal that you have for the money or whatever you want to do with the money, when you specifically start the policy, you can set aside a goal, or a 10-year goal, a 5-year goal, 15-year goal, whatever goal that you want for the money, you set aside, you put that money in that policy specifically for that reason, okay? So an intro to just cash value producing life insurance is it's life insurance that comes with death benefit, but also comes with something that's called cash value. So here's just a quick breakdown of the strategy. Now, year 1 through 5, you want to build up the value of the policy, right? So you build cash value through premiums that you're investing every single month into the policy, or year, depending on when you make your premium payments or investments into the policy. Year 6 through 10, you're still building, but if you decide to pull out some money into the policy, you will have a significant growth that you can either borrow against or withdraw funds from that policy. Now, year through 10, which is the precipice of what this video is about, you use the policy value to make a lump sum payment on principal, right? You do it on the principal because you pay on the principal, the interest goes down quicker instead of just paying the interest payments, okay? So you make a lump sum payment on the principal, okay? Now, something to remember and emphasize is usually, I don't know how your policy is set up, I didn't set up your policy for you. If you want help with me setting up a policy for you, DM, comment, whatever, and we try our best to get out to you. But usually, withdrawals are not taxable. Now, just to drive home the idea just a little bit more, let's say, for an example, you have a $300,000 mortgage and possibly a whole life policy. Let's say you're making the double payments for your mortgage. Let's say you have a mortgage of about $2,000 per month. You're making $1,000 payments every 2 weeks. By you doing that, and a couple other strategies that we spoke about here with life insurance, you will dramatically reduce the amount of interest payments that you have on the home. And let's say, for this example, you pull out $50,000 out of your whole life policy in year 10 to make a principal payment, drastically will reduce the interest and shortening the loan term of the mortgage. Okay, so again, it's not just one way to do it; it's multiple ways to do it. And if you combine different ways of doing things, it drastically reduces it even more. Okay. Now, I know there are going to be some naysayers out there that probably have like, oh, yeah, I have some questions about this, or I have questions about that. So here's some cons about your strategy. It reduces the death benefit if you took out a loan from your policy, okay? It will reduce the death benefit. If you took out a withdrawal, it does not touch the death benefit because it's already your money pretty much anyway. So it's going to reduce the death benefit if you don't pay back the premium loan, okay? It requires disciplined premium payments, okay? So this strategy and pretty much all higher level echelon financial strategies require something that's called discipline, okay? And this is not ideal for short-term needs. So it's going to be something that you're going to have to commit to about 10 to 15 years because this is the plan, okay? So it's not a quick fix or anything like that. And if anyone is promising you that, I'm not saying they're lying, but you definitely have to do a little bit more research on that, okay? Some of the pros, okay, is tax-free access to funds, okay? Accelerated mortgage payoff, of course, that's what it's talking about. And continued life insurance protection using the policy, okay? Here are some tips for success when you choose a high quality, permanent, cash producing life insurance policy, either with strong dividend history if you're choosing the whole life, or specifically if you're doing an index with a strong index potential growth for the next 10 to 15 years. Okay. So you need to make sure it's high quality. You need to work with an advisor to model cash value growth and specific loan timing to make this work absolute best, and you need to avoid over borrowing to preserve cash value benefits. Okay. I encourage you to review, if you have a policy, to review your policy, the net surrender value and stuff like that, and to reach out to me. Okay. Either comment or DM me if you have any interest in going over your policy or possibly starting a policy for this reason or possibly another reason. Okay. Just remember, your mortgage freedom might be hiding in your life insurance policy. So take care.